the mic over to Paul and Brian. I just have a few housekeeping items to cover. First, we're recording the webinar today, and it'll be available on our website, kingwealth.com, at a later date. So if you'd like to go back and listen to it again or share it with somebody else, you can find it there. Also, we'll address any questions that you might have at the end of the session. So as we're going along, if you come up with any questions, please email them to kwp@kingwealth.com. It's on the screen right now, and I'll be monitoring that mailbox, and we'd love to hear from you. So that concludes the housekeeping items, and I'll hand it over to Paul.
Thanks, Elizabeth. And, you know, we're constantly talking with our partners and colleagues about things happening in the news and how they impact investments and futures, and no better partner than Goldman Sachs and Brian Nash. So backed by popular demand, we had him on in the spring, and there's just been a little bit more on the news since then. So although most of the material was prepared prior, I'm sure Brian has some insight into, you know, the latest political activities and how they can affect, you know, future outcomes. And just as a reminder, you know, the investments is just one part of what we do. It's we're really try to be as holistic as we can in working with our clients. So any questions on investment matters or any other life impacts, we're here to help. So, but I don't want to take more of the time. I really want to get to Brian's presentation. So I'm going to turn it over to him.
Great. Well, Paul, Shannon, and Elizabeth, thanks so much for having me today. And Elizabeth, great job on organizing today's presentation. Really appreciate everybody that's taken an hour out of their beautiful summer day to join us. I think there's no shortage of items to talk about here, but ultimately, what you'll hear from me today over call it like 30 plus minutes, and I know that Paul and Elizabeth will be taking in Q&A as well, so please, if you have questions, be sure to pass them along. But for us, there's a lot of different things going on in the market. And clearly, with the election cycle coming up in the news over the last week, you know, there's even new variables to consider as it relates to the US economy, how markets can be impacted. And so as we don't have all the answers as it relates to the elections, I'll certainly give you a kind of up-to-date information as we're seeing it on the Goldman side. But my hope today is just to walk through our economic outlook, cover our perspectives on the markets, both opportunities and potential threats, but more so leave everybody, you know, that's joined us today feeling like they've got a pretty good handle on where things sit right now. And, you know, we never have a crystal ball on how things are moving forward, but, you know, Paul and Shannon have an excellent pulse on what's going on in the markets, and they're constantly connecting with myself and I know other asset managers to make sure that you're in the right position for your financial plan. Now, I thought if I'm in a room with you all, I would actually have everybody raise their hands and give a feel for a poll on what you think about this. But I thought what I would do instead, given we're virtual, is bring you some survey results. There was an interesting national survey done with US citizens, and they were polled on a number of things, both economic and market related. And I thought the polling was super interesting. And, you know, I think you can probably sense it in general. There's just, you know, there's a little bit of pessimism out there as it relates to the data. And at Goldman, like, we're not sure what's driving it. It could still be some post-COVID concerns. It could be that we're paying more for everything as inflation's moved higher. It could be the election cycle that, you know, whether you're right or left leaning can be quite emotional as we move closer to elections. And it could be all of this combined. But the net result, I think, is really interesting. So I'll run through a few of these questions and what the answers were. The first question was, are we in a US recession right now? And again, they pulled thousands of US individuals. 56% of respondents said we're in a recession right now. They also asked, is inflation moving higher? And right now, 72% of US citizens believe inflation is moving higher in 2024. On the topic of unemployment, 49% of Americans believe we're near or at a 50-year high in unemployment. And the last question was, as it relates to the S&P 500, on a year-to-date basis through the end of June, 49% of Americans believe the S&P 500 is negative year-to-date. Now, to provide the answers to those questions, a couple of them, you can look here on the right-hand side to start. And first off, how we measure a recession is, do we have a negative growth impulse, i.e. is US GDP turning negative? And what you can see right here by the first bar chart on the left, last year US GDP came in 3.4%, and we have growth this year forecasted to come in at 2.5. So is the US slowing from a growth perspective? Yes. But we're nowhere near a recession measured by US GDP. And to put 2.5% in perspective, that's actually pretty good growth. Trend GDP, i.e. is the US economy growing at the right productivity level, trend GDP is 2%. So we're still above trend and we're well above zero. And so, here we have more than half the country is saying we're in a recession, and the reality is we're not close. As we think about inflation, core PCE is how we think about measure, the Fed thinks about measuring inflation. And you can see last year inflation was at 3.2%. This year it's at 2.7. Yet 72% of Americans believe inflation is growing, not shrinking. Now, I think this to me makes a little bit more sense on why people might feel that, right? To be clear, we're not in deflationary mode. Prices aren't actually dropping. Prices are just growing at a much slower clip. But the reality is, all of us feel this. You're shopping at the grocery store, you're buying gas, you're shopping for, frankly, most of anything. It is a higher price today than 2020. The reality is we're probably not going to 2020 prices anytime soon, but are price raises slowing? Is the inflation slowing? Absolutely. From 3 years ago, inflation is down by 78%. And so it might not still feel good as we're spending money, but these data points are trending in the right direction. When we look at unemployment, unemployment's at 3.9%. Now, it's not on this page right here, but unemployment at 3.9, we're closer to a 50-year low in unemployment than we are a 50-year high. And so that data point still feels like it's in pretty good shape, but we will get into some of the potential labor concerns in a little while. And then lastly, you work with King Wealth. I'm sure everybody on this call is well aware the market is not negative year to date. The S&P 500 is actually up 17% after being up 26% last year. And so if you've been on the sidelines worried about a recession, worried about, frankly, anything else, reality is you miss some pretty good gains in the market. So I just thought it was an interesting viewpoint on how Americans are looking at the economy and the market versus what reality has been over recent years and current year-to-date data. Now, with that as the backdrop, you can see here with our executive summary, I think you can look at all the concerns, but I think some of the optimism, we are past peak fiscal and monetary policy, meaning last year the Fed raised interest rates rapidly. We saw interest rates over the last couple of years move from 1% to north of 5%. The Fed is done hiking rates in our view. Really, the market's now coalescing. When do they start cutting? And so when we say drag from monetary policy, what that means is everything's been more expensive. Corporations borrowing, it's been more expensive. Any of us trying to buy a mortgage, more expensive. These numbers should start to trend lower, which should be a tailwind for the US economy over time, and at a minimum, not as big of a headwind as we experienced over the last couple of years. Now, when does the Fed cut rates? I can tell you at the start of the year, talking to our CIO of fixed income, he said, Brian, I can tell you my lowest conviction view for this year is when the Fed starts cutting and how many rate cuts we're going to get. And the reason for that is when the Fed starts cutting is data dependent. The Fed is looking at inflation. It's looking at growth. And the reality is the market probably got a little bit ahead of itself coming into this year because we had some good prints in Q4 and the Fed told us, hey, we think we're getting closer. But inflation's challenging to measure and it can become sticky and it can bounce around a little bit. And that's what we've experienced year to date. But I will tell you, the market is coalescing around what Goldman's outlook has been, which is we're expecting the first rate cut to come in September. If we would have had this call 3 weeks ago, the odds on a September rate cut were around 40%. After some pretty good inflation prints recently, the odds on a rate cut in September based on market consensus is around 80%. And so is it a foregone conclusion? No. But as you look at where inflation is, and you also look at where the labor market is, which has gotten a lot tighter, it's more likely than not we're going to get a rate cut sooner than later from the Fed. Now, in terms of the market,
Brian, if I can just add, the timing is one thing, but the direction is the big thing, right? Whether it's the fall or early spring, we're headed in a downward sloping interest rate environment, which is, I'm sure you'll have a piece on it later, but it's a tailwind for bonds, and just it's a good sign that the markets are being more resilient than we were a couple of years ago.
Totally agree with you, Paul, and I think it's a really good point. Like, do we think the Fed cuts a bunch in the next 18 months? No, but the trajectory should be lower rates, not higher. Absolutely, that'll be supportive of the bond side of the portfolio, which tactically to us makes a lot of sense from a risk-adjusted basis. And remember, everyone on the line, when interest rates go down, bond prices go up. So there's a benefit there to the fixed income book, but I'd say on the equity side as well, and this is just domestic equities as we think about the Fed, but as interest rates go down, that is less pressure on equities as well for things like borrowing. And so it can become a benefit to both equities and bonds if the Fed begins to alleviate some of that monetary policy pressure.
And real estate, that's been a sore spot for the commercial side.
Yep, no, absolutely right. I mean, you think about the big, we call them general partners, but the big owners of office in areas where I live, like San Francisco, we all see the headlines and the concern, but the reality is a lot of these real estate companies, it's not about the debt, it's about the ability to finance that debt. And so as rates come down, that debt serviceability only improves. And so you're absolutely right, pockets like real estate should begin to settle and potentially improve in valuation as the Fed's able to begin the rate cutting cycle. Now, beyond just US equities, and you've seen it here over the last month, as rates come down, that could lead to a broadening out of what performs in equities. And let's face it, the Mag 7 is driving the bulk of the returns last year and this year. I believe close to 50% of the returns are being driven by the Mag 7 year to date. But if you look at what occurred over the last few weeks, you've seen US small caps start to perform. And we think a big driver on why small caps are starting to perform is the Fed potentially getting ready to cut, because small caps have a much higher debt burden, typically in terms of the overall pie of assets, than what large caps do. And so that's where you can see some tailwinds, not just in the bond market, but also on the equity side. When we think about risks, clearly the U.S. debt situation continues to balloon. That's something we look out for. I think for all those on the line, I've had debt questions. Paul and I have discussed U.S. debt for 12 years, and it's yet to create a big market fissure. And our outlook for the last decade, as we've discussed debt, is as long as the U.S. government can step to the market, meaning the world, and say, will you buy our treasuries? And the answer is yes, our debt doesn't matter. We can finance in perpetuity. But the reality is, you've got some countries globally, like China, like Iran, like Russia, that are stepping away from U.S. debt. And as our debt continues to grow now, the concern on the Goldman side is interest payments. You're now seeing a bigger and bigger piece of the U.S. debt being tied to interest payments, which means less and less of our collateral is going to go to things like defense and education and infrastructure. And so we hope that Washington will begin to address our debt situation in the U.S., but the reality is, for both Democrats and Republicans, the voters, it is not a top 5 issue. And until it becomes a top 5 issue, Washington is not likely to want to face it, because the minute you go in and start looking at entitlements or start looking at higher taxes, that's the quickest way out of office. And so, this is something that bears monitoring, but we don't expect the U.S. debt situation to unravel markets anytime soon, but it is something that bears watching. Beyond that, clearly we still have 2 wars going on globally, which is disheartening on a number of levels. Also can be proven to be challenging for markets over time. There's geopolitical concerns as it relates to Russia, China, and other big powers globally. So there's many different things you can look at. But I think, if you let the headlines get in the way of your only focus, you can lose track of the fundamentals. And when we look at the fundamentals in the backdrop, it still looks pretty good. And beyond some of the data points on this slide, if you think about 08, you think about 2000, you think about 1995, these were asset bubbles that brought down our markets 30+%. When we're looking at the economy right now, we don't see those asset bubbles in place. Now, you could look at AI and say, is that a bubble? Today it is not. But if there's a bubble forming that bears watching, I would say AI is probably the one to watch. But as an example there, NVIDIA is kind of the poster child for this AI revolution up front. Believe it or not, NVIDIA, in terms of the PE multiple, price to earnings multiple, is cheaper today than it was 2 years ago. And the reason for that is earnings. They have had earnings blow through where the actual price to earnings multiple of NVIDIA has come down. That said, there's certainly a lot of interest there. I think there's an opportunity to invest, but the price always matters.
Right, Brian, so big tech has slowed over the last few days. So do you think that's a sign of things to come?
Oh, I think, it's just a few days. I mean, when you see gains of 30, 40, 50% on the year, pullbacks of 5, 10% are frankly natural to happen, Shannon. So I think it's a very good question, but the view from our firm is no. And so when we're thinking about a broadening out of equities, it's less about names like Apple and NVIDIA and Microsoft selling off, and it's more about other companies starting to perform. So as an example, if the Fed's able to cut interest rates, right now what everyone wants to own are high quality balance sheets, meaning they want to see free cash flow, they want to see positive earnings, they want to see a well-run company that's producing right now. As interest rates come lower, hey, how about the moderate balance sheets? Can those start to perform and get some love from investors? And that's where you've seen some of the small cap recovery of late. You're starting to see, if maybe it goes from the Mag 7 to the Mag 50. Can you get a broadening out of stocks that can perform? As rates move lower, we think yes. And so we call it more of a catch up, where some of the rest of the index performs better versus these names selling off in a big way. But to me, what bears watching, and look, we're going to have earnings next week. 4 or 5 of the 7 Mag 7 are going to report. They're 30% of the S&P 500 index. We're at all-time highs for concentration. If they blow through earnings next week, the S&P has a track to go to 6,000 potentially. If they struggle next week, we're going to feel it in the S&P 500, and those 7 names are 30% of that index. So that's where, in our view, moving forward, diversification is critical. Do we want to own those names? Yes. But we don't think you want to be highly concentrated in those names because of what they've delivered the last 3 years alone. Let me keep going in the presentation, and I promise I'll pick it up and we'll make sure we get to Q&A. But here's some sources of volatility to think about. So the second bar we just kind of touched on. The forward PE multiple on the S&P 500 today is around 20, but the Mag 7 has a forward PE multiple of 37. So if you think back to 2000, Microsoft was a darling during the first tech bubble. Microsoft clearly didn't go away. They had a great business model, yet coming out during the tech bubble, Microsoft sold off 50%. Why did that happen? Investor expectations got too high. Investors were expecting sales growth of 20 to 30%, and Microsoft delivered 10% a year, 2 consecutive years. And so that's where sometimes companies don't actually struggle, but investors just get too far ahead of what they can expect. That's the risk right now more around the Mag 7. But to be fair, we don't think their valuations are out of line. They're producing 2 and 3x the earnings growth of the rest of the S&P 500. The CapEx that they're investing back into their business is 2 to 3x what it was historically. So not only do these companies have a war chest of cash, they're producing much better profits and reinvesting. And so we want to own some of these names. I think we just want to be careful about the weight in the portfolio. Now, I think the challenge that we could see, Goldman's outlook for the year, and I'm jumping ahead, but just to show you this first box, our year-end outlook for the S&P is 5,600. We're at 5,650, give or take. So we're above that outlook. You've seen a lot of the returns get pulled forward this year in the S&P. Right now, we're above by about 5% consensus expectations. Goldman's outlook was a little bit more optimistic for the year. That said, these are all forecasts. And so to say, hey, you're at Goldman's outlook, let's exit equities, that's not our view on things. Like, this is an economy that we think stable, with rates potentially moving lower. You do want to stay invested, but I think you need to set expectations that your equity returns here forward are probably going to be a little bit more muted than what you've experienced over the last 18 to 36 months. On inflation, and I mentioned this earlier, inflation is down 75% from the peak. We are moving towards the Fed's 2% inflation target, but inflation's challenging to measure, and it can bounce around. And so even though right now we're saying we think it's trending in the right direction, inflation can always rub the other way. So that certainly bears watching. And if the Fed has to get put on hold from cutting, you could see a little bit of an equity sell-off, because right now the markets are positioning for the Fed's going to be able to start cutting in the foreseeable future. Geopolitical tensions, you've got North Korea, Iran, China, Russia that are actively against Western interests. How this plays out is certainly something that bears watching as a left tail or bear market event. Look, typically you get a pullback of 2% every 29 days. We're working on 342 days, over a year without a pullback. So if you do experience some volatility in a pullback, frankly, we're overdue. I wouldn't be overly concerned by a modest pullback. And with the current market valuations, like, frankly, this probably something that will happen over the next couple of months in our view. But again, we think the economic backdrop feels sound. And here you can see the inflation move. So we are paying more. And the inflation move we've experienced is massively different than the average run rate of 2% inflation going back to 2014. So we feel this, but again, you can see the pace of change here and how now it's slowing, and we would expect inflation to continue to edge in the right direction. Sources of stability.
Well, a lot of that inflation was really monetary policy, right? It was printing a lot of money, which hasn't all percolated into the economy, but most of it. And so I would expect that's the big driver for lower inflation.
Absolutely, Paul. I mean, it was a ton of printing of money, and frankly, look, a lot of it was needed in COVID to really support our economy, to make sure things didn't go completely sideways. But you print that much money that quickly, and it's going to create kind of interesting dynamics in the economy, one of which was there was just money sloshing around and prices skyrocketed. When you think about sources of stability, the misery index looks at a combined measurement of unemployment and inflation. And if you think about an individual, high unemployment, high inflation, that doesn't feel good, that's misery. Right now, even with where inflation sits, 78% of the time, people feel worse than they do today based on unemployment and inflation. And so things are actually in a pretty good spot for the consumer. What I would look at, and it's not perfect, and I'll get into that, but if you look at the lower left, this is something we look at quite a bit. Because look, what's real out there is credit card balances are at record highs. Now, we would say that our economy is predicated on credit, on debt. And so frankly, if we're growing as a US economy, we're probably always going to be hitting record highs in credit card debt. The question is, are those payments coming through versus people ballooning on interest? And right now, things look pretty good. So if you look at this chart on the lower left, this is looking at debt serviceability for US consumers, i.e., do consumers have the ability to pay down their debt? And you can see from 2000 to 2008, debt serviceability for the US consumer was considerably worse than it is today. And outside of when there was a big printing of money pandemic, this is the best debt serviceability for a US consumer in 25 years. And so, it bears watching, no doubt about it. Bank accounts are moving lower. Lower income earners have eaten into most of their savings. But at the high income earner level, or even the moderate income earner level, Bank accounts are still bigger than they were pre-pandemic. There's still a ton of cash on the sidelines. And although spending is slowing, spending has remained really resilient. And so we do not expect the consumer to roll over this year. Next year, I think bears watching as unemployment also gets a little bit tighter here. But overall, the consumer's been healthy. And at the upper bound level of the US consumer, spending is still quite robust. Household wealth in the 98th percentile as a percentage of disposable income in history. Again, money markets, we still have close to $6 trillion in cash. That's money that ultimately is going to be deployed. So that's going to be a support for the broader markets. But consumers generally are, again, in a pretty good spot. And I think the last point on that is real income growth this year, i.e. what are we making above inflation? Real income growth should come in around 2%. And so inflation's painful, but US consumers are making above and beyond inflation on the average. What I think is interesting relative to, say, the UK or Australia, where you're seeing some real pain, US mortgage holders learned from 08. You look at this chart in the lower right. Here we're looking at the average mortgage rate for a US consumer. Take a look at this. Most consumers have a mortgage sub 3.5. What's really interesting here, though, is in 08, about 40 to 50% of mortgage owners in the US were on a variable rate mortgage. Today, less than 5% of US citizens are on a variable rate mortgage. And so as interest rates skyrocketed in 08, that was incredibly painful. People were underwater and unable to pay their mortgages. Today, interest rates skyrocket. It's really not affecting homeowners. Now, it's really painful for first-time home buyers or for homeowners trying to move, but as it relates to homeowners, they're in a pretty good situation. You look at the UK and Australia, 70 to 80% of mortgages are variable. And so you're seeing the consumers there slow quite a bit more than the US right now. Briefly on this, I mentioned earlier sentiment at the start and how people don't feel great about things, but the data's actually been pretty good. So here you can actually see it in the chart. The purple lines measure hard data, hard economic data, the number of widgets bought, the number of homes purchased. These are tangible figures that we can measure. The green bars measure sentiment. How do we feel about buying something? How do we feel about the economy? How do business owners feel about the market backdrop? And the reality is, if you're an economist, you look at all of this data. But if you were to break it apart, the soft data for the last 2.5 years would tell us we are in a recession or about to go into a deep recession. It hasn't happened. The hard data would tell you this economy is on pretty darn stable footing and should work out okay. And that's how it's played out. Now, almost any economist you speak with will tell you they look at all the data, and frankly, we think you should. Goldman tends to rely more on the hard data than the soft data. Number of cars bought is factual. And how people feel, again, like we talked earlier on, that could be geopolitical, it could be inflationary, it could be COVID related. You don't really know the reason there. But at the end of the day, if the consumer's spending that is real, how the consumer feels, it's a little bit different. But when you hear economists say, oh, the data's telling us things are about to turn south, more often than not, they're looking at the sentiment. And so for us, it's kind of interesting when you dig into the details here. 30 years ago, when you did a survey, it was all done via phone. And if you called my house, I was born in 1980, and in the mid 80s, likely my mom would answer the phone. She had it on the landline. And if a US survey person called, maybe she had 15 minutes to answer some questions. Today, they're calling your cell phone. Who's answering an unknown call? And even better, who's answering the call from the Department of Labor? And so what's happened is 60s, 70s, and 80s, the response rate to a survey was around 30 to 35%. Today, it's 2.5% of people respond. And so this is more theory than fact, but what we wonder is the people willing to give those 20 to 30 minutes and answer that call, do they maybe have an axe to grind or an overly emotional view that they're trying to get through, or they're willing to give up 30 minutes, or maybe some of these sentiment data is a little bit skewed? We're not so sure, but that's why we rely a little bit more on the hard data. I'll skip over this, as I know we've talked about inflation and how it's coming down. We talked about monetary policy. We expect the first cut to come in September. On GDP, again, 2.5%. We're above consensus in most markets for growth. What I would tell you here is consensus at the start of the year for US GDP was 1.4%. And so you've seen the Fed and consensus grow their expectations that the US economy is stronger literally every month over the course of the year. We've remained, I'd say, a little bit more optimistic than most for a couple of reasons. We've expected the consumer to hold off or be more resilient than I think some of the competitor data that I've seen. And again, we think the Fed's going to be able to cut in Q4, which will lead to a little bit better growth profile. But these growth numbers are strong. And you know, for us, like, this is why you want to remain invested in equities and risk assets. If growth is good, and now monetary policy has become less of a pressure, you know, again, this is a market that we think can continue to hold. For capital market forecasts, you can see our 6-month outlook, which would be year end, is 5,600. And as of today, I think we're at about 5,650. I don't know where it was right starting the call. 12 months out, we're at 5,700. So look, on a US market, you might say, well, why do we want to buy equities if your outlook is 1% upside and we know something could go wrong? I'll come back to this page, by the way. This page here gives you a path of outcomes. So David Costin, who's our institutional head of research, when we hit our year-end target about a month ago, he put this piece out. Now, you can see there's 2 upside scenarios. First scenario, 6,300, is what I said earlier. It's the Mag 7 crush earnings next week, and they just drag the rest of the market with it. NVIDIA, Apple, Microsoft, Amazon, they keep performing. And frankly, the rest of the market can kind of do whatever, but they're going to bring this market higher. It's not Goldman's base case, but to say it couldn't happen, it's certainly in the realm of possibility here over the next couple of quarters that the Mag 7 keeps outperforming. Second scenario, which we would say maybe is a little bit more likely, is that the Fed's able to begin to cut rates, the disinflation environment continues to play out, and now you get more stocks that start to perform, and that's where we could get a little bit better return on this market than what we're currently pricing in the year end. The bear scenarios would be, hey, we get a pullback, but I think the positivity there is this isn't 3 years ago. We don't have interest rates at 1% where the Fed had very little maneuvers they could do to help curtail a big downswing in the market. Today, if we start pricing in a recession, you know, one of these geopolitical risks bubbles up into something more than it is today, the reality is the Fed has some defense for us now. We've got interest rates at 5%. If the Fed needs to, if we start seeing a market that drops 15%, we think the Fed steps in and they begin cutting rates, which closes off that left tail. And so we're in an environment that we think equities are going to be more, call it single digits moving forward with more volatility. But look, like, to say you don't want to be invested in this market, like, there is upside opportunity. But given this range to us, like, this is not an environment to own just US equities. This is an environment for a well-diversified portfolio where we think equities can give you a good driver of return, but frankly, things like fixed income start to look really interesting when this is our equity backdrop. And so you can see, you know, look, Euro Stock 600, which is largely Europe, you know, there you've got about a 30% discount to US equities. So can you get maybe a little bit better return stream? Maybe, maybe not, but to us, like, developed international, picking the right companies there, there's certainly some value. And you're going to have the ECB begin to cut rates probably earlier than what you're going to see from the Fed. And so that's a scenario where, hey, maybe you want some of the international. I think an EM for us, you'll see a higher return print here. Goldman's challenges with China, and we do think there's demographic challenges there. They've got some challenges around restrictions on their tech names. You know, do we think China has a big recovery? Frankly, we think they've got a lot to work through. And China's 50% of the emerging market index. So being selective in emerging markets, we do see opportunities. But you know, China's one that we're a little bit wary of. And look, if you get a Trump White House, there's going to be significant tariffs likely to put on China that could create more pressure in EM, not less. Something that certainly bears watching moving into next year. Now look, getting into bonds for a second, I don't think this page does it justice. I want to jump ahead. So how do we think about fixed income? So one, August 20th, October 23rd, and June 24th. August 20th, the income you were earning in high quality fixed income was in the 0th percentile relative to history. The return asymmetry, i.e., how much do you lose when interest rates go up? How much do you make when interest rates go down? Was not attractive in 2020. And the capacity to hedge, would bonds perform when equities didn't? The value wasn't there with very low interest rates. You look at where it sits right now, the value is absolutely there to own fixed income and high quality bonds. And when we get into what return asymmetry means, it's this chart on the right. In August of 2020, if interest rates went up 1%, and remember in 2020 they went up about 4%, you're going to be down 9% in your price if rates went up 1% in 2020. Conversely, if they went down, you'd be up 10. So it was almost a 1-to-1 ratio in 2020. You look at it today, if interest rates go up 1%, you'll be down about 3.5%. But if interest rates fall, and right now we think the Fed's going to cut because inflation's moving lower, but look, let's say a recession came into view, or again, a geopolitical risk became more pronounced. If the Fed starts cutting interest rates aggressively, your high quality bonds will work as the defensive posture you've known over your investment cycle, not what happened in 2020. If interest rates fall 100 basis points, the US aggregate bond index is going to be up 12%. And so that's where, when we look at high quality bonds, they certainly haven't performed like stocks the last few years. They've been more of a headwind than a benefit, but that hedge, that capacity to produce returns if stocks don't, is absolutely relevant again in terms of portfolio construction and what bonds can do to mitigate risk and help protect your portfolio should something go wrong in the economy or in the world. Lastly, and I'm happy to check in to see if you have questions, but I was going to go to the elections, Paul. You tell me if you have any questions so far. Good.
We have a few, but we can cover them at the end, Brian.
Okay, great. Yeah, I'll wrap this piece in just a minute and we can go to Q&A. But, look, obviously the last week and a half has been, something that we've never gone through, at least I haven't in my lifetime, with Biden stepping away. It's a fluid situation as it relates to Kamala Harris and the Democratic Party, but it sure looks like, as of this morning, all signs point to enough Democratic delegates up front approving Kamala, where it doesn't look like there's going to be a competitive situation at the Democratic National Convention. It's not a foregone conclusion, but it feels like that's about 95, 98% baked. And so more than likely, it's going to be Kamala relative to Trump for the presidential election. I saw some polls this morning that said Kamala was maybe a little bit closer relative to Trump. One poll said she was 1% ahead. A couple others said she was 1 or 2 percentage points behind. Frankly, all of that is within tracking error. So more than likely, in our firm's view, this is going to be a close election. It's going to look really similar to the last couple, where it probably comes down to the wire. Now, the prediction markets, predicted.com is kind of an interesting one to look at. If you like, that's the prediction market that we kind of track. It's showing things, again, modestly closer. So, this side, looking at Biden, not all that interesting, but what I would say is Kamala's platform and policies, we don't think are going to shift very much from Trump. I'm sorry, very much from Biden. We think the policies largely will be pretty much the same. When you get into the states that are up for grabs, you can see them in the orange. These are largely the states that are going to decide the election. Now, some of these are a little bit closer than others, but the reality is you've got 6 or 7 states that are going to decide the election, and within those states, it's going to be the independent voters. So you could fit around a football field of people that will decide the U.S. election come November.
And Brian, to your earlier point about polling, it's been very inaccurate the last couple elections, so I don't put a lot of stake in it.
Yeah, they say the tracking error is 2 to 3%. It feels like it's about double that, Paul.
Yeah, exactly.
Now, I think what's most important, though, to get across, look, from a tactical perspective, and this is where Paul and Shannon and team are dialed in. You know, right now, the odds of a sweep from either party would say the Republicans have the highest odds of a sweep at about a 44% odds. The Democrats' odds on a sweep are quite a bit lower, but the reality is the House and the Senate are really, really narrow. And so more than likely, we will have a divided government, which the markets do like, because that means political gridlock. It means we know the policies in place, we're likely not to have a lot of changes, and the market likes known inputs. That said, you know, if you were to get a Republican sweep, you're likely going to get an extension of tax cuts. That's probably the biggest market dynamic as it relates to the election, is do we get an extension of corporate and individual tax cuts relative to what happened with the last Trump tax plan? And that's up for extension or not in 2025. So that probably has the most market impact. On a Republican sweep, you're going to get the tax extensions. You're going to get an increase in tariffs. You're likely to get less immigration, which means more challenging wage backdrop. All of that would be inflationary. So Paul, to your comment earlier near the beginning, if you get a Republican sweep, like could that, you know, create more inflationary pressure that means the Fed is further away from cutting, you know, next year? I think that's something you have to consider. But again, more than likely, we'd expect gridlock. I think the biggest point to make, though, is this chart right here. This is looking at R squared, which is measuring, is there a statistical significance to how the market performs and who the president is, what party controls the Senate, the House? You look at this, the answer is unequivocally no. There really is no fact-based statistics that tell you who is in office will dictate what direction this market goes. So it's very important to vote. If you care about politics, stump for your candidate, vote for them, do everything in your power to get them elected. Please do not let that implicate how you invest. Whether you're on the left or the right, we see this time and time again. You know, that's why you work with King Wealth, have the conversations, but you know, stick to your financial plan, and you're in really good hands with King Wealth. So let me stop there with my prepared comments, turn it back to you, Paul, and you know, happy to open up to any questions.
All right, thanks, Brian. As always, a lot of statistics probably and things that we haven't seen before. And I'm headed to Hong Kong and China on Saturday, so I'll give you my report from ground zero over there.
Oh, I'll be definitely interested.
Yeah, my wife actually owns some real estate there, so we know a little bit about the economy and the real estate difficulties they're having.
Interesting.
So Elizabeth, any questions?
I have a couple here. So the first one is, we know the government controls short-term interest rates, but what is the outlook for longer-term loans like auto loans and mortgages?
Yeah, great question. We don't expect the long end of the curve to move materially lower anytime soon. So right now you've got the 10-year treasury around 4.25. In our view, that feels like about fair value. So could you see it modestly move lower by a quarter point over the next 6 to 12 months? We think that's reasonable. But you know, with growth this strong and inflation moving lower, it's not likely you see the long end of the curve revert back, certainly not back to where we were 4 years ago. But you know, do we see a 3 handle next year? We don't think so. So you might see a little bit of mortgage rate relief, but frankly, the long end of the curve feels like, in our view, it's in a pretty good spot right now. Great question.
Okay. This one's sort of related to what we were talking about before, but Democrats call for tax increases and Republicans would likely push for tax cuts. Which one would have more impact on the markets, a tax hike or a tax cut?
Well, so tax cut would be more positive. Tax hike would be a little bit more negative in general, right? Because tax hikes just takes a little bit of buying power away from all of us. And so that's where, you know, traditionally that's kind of what you would expect. The only reason I didn't go through the Democratic side earlier is the likelihood of a Democratic sweep is a little bit lower. So in the interest of time, I just kind of covered the right now what the highest probability is. But no, it's a great point taken. That said, if you get divided government, it's unlikely we're going to get a big tax hike. it's also unlikely we get a big tax cut. So that's where there's a little bit of a gray area if it's divided, which is probably the most likely scenario right
Mm-hmm. And one last question, what are your thoughts on buying precious metals in the market?
Yeah, we've been bullish on commodities. You know, in inflationary environments like this, especially where you have central banks around the world printing money, you know, commodities feels, in our view, like a pretty good diversifier in portfolios. So we've been bullish on gold as an example, and that's performed really well here over the last 12 months. The thing about commodities, though, that I think you have to take into account is, believe it or not, like a diversified commodities portfolio, whether you buy it in a mutual fund or an ETF, it has the volatility profile, the risk profile of emerging market equity stocks. It is highly, highly volatile. And so the challenge that we've experienced at Goldman is it's also not always rooted in fundamentals. Now, look, we can see printing of money and say, hey, owning something like gold might be nice as a hedge. Historically, it works well in inflationary periods. But you look at something like oil, which is a big component of any diversified commodities fund, and oil is a lot of times dictated by OPEC and what Saudi Arabia wants to do, and fundamentals, you know, be damned. And so trying to say, hey, now's the time to buy, just know, you know, if you buy gold out, like, that tends to have a lower volatility profile. You buy broader commodities, things like industrial metals like copper can be really volatile. Things like oil can be really volatile. And so, you know, if you want to put a little bit of inflationary hedge, I'd recommend you talk to Paul and Shannon to make sure it's appropriate for your risk profile. But in general, you know, we think having some commodities in this part of the cycle, you know, can make sense for the right risk profile.
All right, Paul, or Shannon, anything to add at this point?
I wanted to ask again about inflation, since I think that's what a lot of clients and consumers are interested in hearing about, and especially with the idea that the House and the Senate are going to be gridlocked no matter who wins. We'll think, you know, don't expect a lot of change. So historically, what's the lag between inflation measurements like PCE and CPI and actual deflation, which you talked about earlier? When can Americans expect to feel some relief?
Yeah, I mean, I'll be honest, I don't think we're going back to where we were anytime soon. This market regime, you know, was that 5-10 years, feels like we're just going to have, frankly, 4% inflation is normal inflation. What we experienced from the prior 10 years was abnormal. And so to us, like 3.5%, 4% inflation feels about right for probably the market cycle. You know, there's just too much demand. You know, barring us going into a recession where demand dissipates, that's probably the fastest driver to see some deflation. We're not, but right now we're not modeling that in. We think, you know, the reason I kind of skipped over, I don't love the title on this presentation. We change it about every quarter. It's called Arrival. But what that's really kind of talking about is, hey, we're finally moving away from the pandemic, but some of these data points, like the long end of the yield curve being around 4%, inflation being more elevated, we think this is the new normal, not something that's going to revert back to what it was in the next 12 to 18 months.
Okay.
Trust me, I wish we were going to see prices go back. Right now, it's not in our purview.
Well, thanks, Brian. Appreciate it.
You know, that's a great data point for our financial planning, is always trying to project inflation and equity returns. Definitely we got to ramp that up. So we'll close on that. Appreciate everybody. And Brian, to tell you, our webinar software tracks attentiveness, and it was 100%. So people are tuned in, and I'm sure we'll get more questions dribbling in over time. So thanks again.
I'm glad to hear that, but it may have been that I said I was saving the election piece for the end of the call. I'm not sure.
Yeah.
But thank you so much for having me.
I see what you did there, Brian.
Come off and let me know, and I'm happy to address them.
Thanks,
Okay.
everybody.
Thanks for joining us.
Have a great day.